All right, I think we're going to get started. Happy Thursday, everyone, and welcome to today's complimentary webinar where Dr. Lev Borodovsky, Chief Risk Officer here at Star Mountain and editor of the Wall Street Journal's The Daily Shot, will be discussing a potential U.S. recession. My name is John Polis, and I am the Chief Operating Officer here at Star Mountain. We are a specialized asset management firm focused on investing in the U.S. lower middle market. We employ a data-driven approach to provide value-added capital to finance growth initiatives of established small and medium-sized companies. Our platform is powered by custom-built technology and a deep and experienced team that has been investing in the lower middle market since 2001. Before I do hand over the reins to Lev, I did want to let you know that your audio is muted and will be for the entirety of the presentation. Also, as a disclaimer, I wanted to note that nothing presented in this webinar or in webinar materials constitutes an offer to sell or a solicitation of an offer to purchase by Star Mountain interest in any investment product. We have allocated time at the end of the presentation for Q&A. If you do have a question, you can type it into the Q&A chat box of your WebEx client that should be on the right. We will try to get to as many questions as possible before the hour is up. Lev, we had a lot of interest, and we had a fair amount of people register for this webinar today, so it must be a very interesting topic, and we're very happy to have you here with us today to speak about it.
Thanks, John. Really appreciate it. I'm glad to join in this discussion. It's been a lot of back and forth, and you hear a lot of noise in the media. And my goal today is kind of fly through a bunch of material and take a broader picture of try to cut through the noise and see where we are with respect to recession. And the conclusion that I've come to recently is that it's going to be a while. I mean, the next recession is going to happen, but it's going to be a while. So let's get going. Okay, so a lot of stuff to cover today. The first thing we're going to look at is recession concerns. Why are people concerned about recession coming? Then we'll look at some of the signals we're getting and what's been spooking the markets and the media when it comes to some of these recession signals. Then how have central banks responded? And we'll take a look at the situation with the consumer. The consumer is a huge portion of the U.S. economy, and it's critical to take a look at. We'll also take a look at a couple of slides on the U.S. housing market and what's going on there. We'll see some more recent high-frequency economic indicators. We're going to look at some what's the market telling us about the risk of recession, and what are the various sentiment signals telling us. We're going to look at the global backdrop. The global economy is still highly interconnected, and so it's important that we do that. And then we're going to, there's obviously going to be some issues where people say, but what about this issue or that issue that's still unresolved and that could lead to a recession. And then we're going to look at risks. What are the potential risks? There's no shortage of those. And kind of look at a few of them. And then we'll conclude with a couple of interesting slides. So let's get going. Recession concerns. So this expansion has been the longest on record, as you can see, and it just keeps on going. And that's surprising. It surprised a lot of economists and analysts that that's going to continue. And of course, once it gets to this length, people are going to start saying, well, just historically, this cannot last much longer. It's got to end somewhere. And so that was kind of the first concern that people have raised. globally, if you look at the world, here's the kind of economic cycle. The bulk of the world economy is in the slowdown mode. There are a few countries that are in recession. There's a few small, emerging market countries that are recovering, a few emerging market countries that are in expansion, but the bulk of the world's economy is in slowdown, and that's another sort of item that raises concerns, the bulk of it. In the U.S., what spooked the markets and economists has been the manufacturing slump. And manufacturing took a hit from trade. It really was that simple. It was trade tariffs that put brakes on both production and investment, and so here's the U.S. manufacturing output. So this is hard data. This is actual manufacturing output, and it's been contracting. But notice that we've seen this movie before. It was right here, right? And we didn't get into a recession back then, and so we're kind of in a similar place. And we'll talk about it. This is what people refer to as another mini cycle. So here's one cycle, and here's another cycle. Of course, manufacturing is a relatively small portion of the economy, and the concern was that can manufacturing drag services down with it? And so business surveys have been pointing to slowdown globally in services as it follows manufacturing down, because they're interconnected. So manufacturing tends to be kind of the leading sector, and it can drag other areas with it. But in this PMI measure, anything above 50 is still in expansion mode. And so yes, services have slowed, but they're still growing. And again, take a look at this interesting pattern. There's a slowdown here, there's a slowdown here, and there's a slowdown here. So it's a third, what's called mini cycle that we're going through. Similarly, on the right side, we have trade in goods and services, and you can see that services trade has been slowing with manufacturing. We've talked about this before. There's corporate leverage has increased, so there's been a lot of debt issuance, especially if you look at absolute debt numbers or debt ratios to the GDP. In particular, there's growth in leveraged loans, and so people are concerned about this is not going to end well. Earnings calls, and this is globally, earnings calls, the biggest concern this year has been late cycle, meaning the cycle is ending, and so corporate executives are worried that more than anything else, they're worried about that we're going to end the cycle, meaning hit a recession. And of course, the media has been very helpful in terms of spooking the markets and the consumer. So we have this constant headlines. Are we hitting a recession? We're going to be in a recession, and obviously when the consumer hears about that, it becomes become nervous and less likely to make purchases, or more likely to and similar with businesses, especially small businesses, less likely to hire, less likely to invest, and so it becomes a self-fulfilling prophecy. And the consumer it has indeed been nervous. At least, some of the soft data has shown that. So the chart on the left is Google search activity for recession or next recession, and that has been elevated, kind of in the last year to 2 year and a half probably has been elevated. The public is concerned about the U.S. hitting a recession. On the right, we have the unemployment rate in blue, and red is appetite for buying durable goods. Again, it's a survey from the University of Michigan, and it's inverted, right? So it basically shows that the appetite for buying durable goods has decreased, and could that potentially bring the unemployment rate higher? And this is a pretty good fit. So if you just kind of look at this as kind of a scary chart, because it says the unemployment rate has bottomed, and this is the kind of stuff that's been worrying economists. So what are the signals that we're getting about the economy being in the late phase of the economic cycle? Of course, the most famous one is the yield curve inversion. So if you look at longer term yields, like the 10-year Treasury, and compare that to short-term yields like the 3-month Treasury bill, that measure dipped into negative territory, which means that the shorter rates were above the longer rates, and that, as you see in the past, was a signal for recession. Now, it's worth noting that there could be quite a bit of distance between this inversion and when the recession actually hits. So if you look over here in the late 80s, you had quite a bit of it was like a couple of years between the inversion and when the recession actually hit. And also, it's worth noting that just the fact that it rose, basically the curve has straightened out. It's no longer inverted. Doesn't mean that we're out of the woods. It just says, the signal was there like it was before, and now it's just a matter of time before we hit a recession. That's what this says, right? Now, people debate the strength of the signal. For example, the Federal Reserve would say that term premiums, the premium investors require to buy longer-term treasuries, has declined. In fact, it's negative. And so because of that, this signal is not as strong as it was in previous years. This chart on the right is a similar one, except it compares the 10-year Treasury yield with the Fed funds rate. And that was also inverted. There are other sentiment indicators that show that we're clearly in the late phase of the economic cycle. The one on the left is the spread between the Conference Board's consumer expectations versus current conditions. So if current conditions index is much stronger than the expectations index, that tends to be a signal. And it was actually a pretty reliable signal of recession. Similarly, on the right is the spread between the Conference Board's current situation index and the University of Michigan current situation index. And for some reasons, historically, that spread, when it rises, peaks, is a indication of an impending recession. And here are some other measures that people keep pointing to. I like this one in red. It's the CEO expectations versus consumer expectations. So if the CEOs that tend to be on the front line of the economy versus the consumer tends to be more of a lagging measure of the economy. And so when the spread between CEO expectations and consumer expectations goes way into negative territory, as this has, it tends to be a good predictor of recessions. And then on the right is kind of a measure of output gap. An output gap here, the way I defined it, is simply the ratio of the GDP to potential GDP. Potential GDP is a calculated measure that basically says, given the population growth or labor force growth, and given the productivity growth, how fast can the economy expand, without generating a lot of inflation, and that's kind of this ratio is an indicator of output gap, and you can see every time it peaked in the past, we hit a recession, and appears to be peaking now. So clearly these are indicators that all point to us being the late phase of the economic cycle. And then there are recession models that are based on the yield curve and some other parameters. The one on the left, for example, is from Moody's Analytics. The one on the right is from Oxford Economics. And Oxford Economics is using the National Activity Index from the Chicago Fed and combines that with the yield curve indicator, and produces something that's above 50% probability of recession. It's worth pointing out that not all these models have been giving the same signal. So here's a recession model from Morgan Stanley, and yes, it's risen, but the full model, which is the green line, really is only sitting at 11% probability. So you got to take these models with a grain of salt there, depending on sort of the assumptions that they're using and which indicators they're taking into account. You'll get a very different set of results. Of course, professional forecasters have also been nervous about possibility of recession. And so this is a survey from the Wall Street Journal of economists measuring the probability of a recession in the next 12 months. That's been, sort of in the over 30% type range, which is enough to get people nervous. So with all these ugly little indicators from all over the place and signs of being late phase of the economic cycle, central banks obviously responded pretty forcefully. Just looking at the Fed, we've had 3 rate cuts. That's the chart on the left. The chart on the right shows the Fed's balance sheet. And you can see that within a matter of a couple of months, the Fed reversed some 40% of all the quantitative tightening that it did very rapidly, right? Now, this jump here is, they wouldn't call it quantitative easing. This is, they will say, is in response to the squeeze in the repo market that we've had, and that's a whole other presentation that we can talk about. But nevertheless, it's a pretty sizable increase in the balance sheet, injecting liquidity into the market, which in general tends to be a positive has a positive impact on the economy. So we'll see that if you look at kind of the real economy, which is the things like auto loans and personal loans, you'll see Fed cutting rates takes time to propagate through the real economy. And so this latest cut right here will result in lower interest rates in the real economy. By the way, it already has resulted in lower mortgage rates, which we'll talk about shortly. But this will definitely have a nice positive impact on the consumer and the economy as a whole. And globally, central banks went all out and started easing, and you can see that 60% of the world's central banks are now easing. This percentage, 60%, is the highest in a decade. And the chart on the right shows that this is basic central bank, the number of central banks hiking minus the ones easing. You can see what happened just in recent months. It's pretty spectacular. They basically everybody from China, as we saw yesterday, to Mexico, everybody's been easing. I mean, the Russians have been easing. Obviously the European Central Bank, all over the world. So it's a pretty synchronized central bank easing, and that again tends to be a nice tailwind for economic growth. So let's quickly talk about the consumer. And it's critical, right? The U.S. consumer is critical. And why is that? Well, because U.S. consumer is 17% of the world GDP. That is larger than China's whole economy. Again, the U.S. consumer is larger than China's whole economy. And so it's if you think about it, it's a critical component of global growth. And so it's the health of the U.S. consumer is vital in terms of figuring out whether we're going to get a recession. And this chart, it's been shown quite a bit, but probably not enough, is the fact that unlike sort of the previous decades, consumer leverage has been declining. So if you look at, in this case, it's household debt ratio to disposable income. You can see that ongoing persistent decline. So consumer continues to deleverage, right? And that's not an indication of any sort of consumer debt-driven economic issue. Now, people will say, well, the consumer is facing other problems like, expensive health care and other issues. And that's correct, So there are definitely pockets of weakness in the consumer economy. But overall, this data is unmistakable. The consumer balance sheet is in good shape, relatively. The other thing that's been happening is kind of interesting is consumers have been, U.S. households have been saving, and the saving rate continues to climb. So, and that again, that's a positive, because if you can imagine an economic slowdown where you have maybe slower employment growth, or even increased unemployment, given the fact that consumers have saved, and, more have savings, it's an indication that again, balance sheets are healthier than they have been in the past. So it's definitely a positive. Then the housing market. So as the Fed was tightening over the last sort of few years, mortgage rates went through the roof with relative to recent levels, and it created a problem for the housing market. So we had so here's the Fed tightening, Treasury yields going up, and people say, well, it's not a big deal. I mean, 5% on mortgage rate is not a big deal. In this economy, it is a big deal, right? It is when housing prices are high. Home buyers are very sensitive to mortgage rates. So going from sort of 3.5% to 5% is a big move, right? And that started to pressure the housing market and so on. But starting late next year, we had a huge reversal in this. Um, and this is, if you think about it in terms of the Fed, this is equivalent to the Fed cutting rates a few times, right? So it's a real boost, this move. And you can see that showing up in home builder optimism index. So you can see home builder optimism dropping as mortgage rates go up and rising as mortgage rates go down. It's a direct relationship. And this particular index is home builders' view on single family home sales over the next 6 months. So we'll see a rebound this year. And just as we saw yesterday, building permits hit the highest level since 2007. So all of a sudden you have this, again, you have a drop that's more mortgage-driven drop and a rebound as you have pent-up demand and lower mortgage rates, and all of a sudden you have this this real improvement. And you can see here economic surveys showed 1,385 building permits, and you can see the actual number that came out was substantially larger. So construction, residential construction is really picking up, and that's and it's a big driver for the economy. Housing by itself is not a significant portion of the GDP. It's substantial, but it's not a huge portion.
Okay.
But the knock-on effects that it creates in the economy is significant. And so, things like, durable goods spending, housing, furniture, electric appliances, kitchenware, and so on. All of these things, housing is a big driver of those. So this jump is important for the economy. Okay, so let's look at the other sort of recent economic indicators. Here's the leading economic index. Basically, if you look at multiple leading economic indicators and you turn them into an index, the black line is what that is. But the black line is interesting, but it's not really. What's interesting is the yearly changes in that index, and that's the green curve here. And again, you can see this interesting phenomenon going on. So we had 3 downturns, right? 1, 2, 3. But we're still in positive territory, right? And anytime we're about to hit recessions, we typically went into negative territory. Here, and so on. We're still in positive territory. And again, these are the 3 mini cycles that we've had in this expansion. And what are they? Well, this first downturn, you're talking about 2011, which is the Eurozone crisis, where for those who were in the markets in 2011, remember it's a pretty scary time, certainly not as scary as 2008, but pretty darn close in some instances. There was pressure on financials. We've had the U.S. Credit rating downgrade. We've had the debt ceiling, and in Europe, things got really frightening because there was concern that Italy will default, and Italy defaulting will bring down the financial system globally, basically, and put the world into a depression, because the world is so exposed to Italian debt. It's such a huge part of the global debt markets that it will propagate through this. I remember talking to somebody at a large German bank, and I said, "How are you feeling about the situation?" And they said, "Well, if Greece goes under, no big deal. Portugal goes under, no big deal. If Italy goes under, we're out, right? Basically, it's going to break them." And so this was that first dip. The second dip was basically had a situation where the dollar rallied sharply, which put pressure on U.S. manufacturers, and at the same time, China had a devaluation in its currency and had a sharp slowdown in its economic growth, and so that was this one. This is when oil prices dipped down to low 20s, and there was concern about deflation and issues like that. Negative interest rates in the United States and so on. So that was that second one, and the third one is the trade related downturn which we've had. So we had these three little mini cycles, which is a pretty important point here. There are other economic indicators that also suggest that we're not anywhere close to a recession. So the one on the left is it's kind of an interesting one. It shows deposits at U.S. Commercial banks, and you can see that little rebound in the mini cycle rebound in deposits. The chart on the right is a credit size macro index, and again, it's a little bit of a decline here, but nothing like we've seen prior to previous recessions. So, what are the market sentiment signals that we can point to? So here's one. This is the Goldman Sachs Financial Conditions Index, and the higher the number, the tighter the financial conditions. You can see the spike here. This was the end of last year when we had a 20% crash in the stock market, and things got pretty dicey, and credit spreads blew out, and so you had this tightening of financial conditions. This shows continuing easing of financial conditions, in part because the market rallied, rates declined, the Fed eased, and so you had this nice easing. So that shows improvement. The stock market is also telling us that there's less concern about a recession. So this is a little subtle, but it basically takes a basket of stocks that benefit from the economy being late in the economic cycle, or ending the economic cycle ending, divides by a basket of stocks that get hurt by being late in the economic cycle, and that ratio has been declining, with the market's becoming less concerned about the economic cycle ending, right? So the declines. Fund flows also show that the market is less concerned about a recession. So you see the green line is a global composite PMI. It's a business activity around the world. Has been showing signs of stress. And again, here are the three cycles: 1, 2, 3, right? And this the fund flow indicator shows that the market is becoming less concerned, and signaling that we'll probably have a recovery in business activity. The credit markets are also telling us there's not that much concern, in the credit markets about a recession. This is triple B corporate bond spreads, and they tend to rise before each of the previous recessions. and they have been declining lately. So another interesting indicator. Fund manager survey from Merrill Lynch. So fund managers are now less concerned about a slowdown, a significant slowdown in the next 12 months. So you can see that rebound. Again, cycle 1, cycle 2, cycle 3. So global backdrop. Global indicators are also helpful, particularly if you look at surveys like PMI surveys, like automobiles output index or manufacturing export orders. You see a bit of a rebound here, and these are high frequency indicators, early signals that companies are becoming a little more upbeat. So that's the rebound. This chart is from Morgan Stanley, and it shows again 3 cycles: 1, 2, 3. Developed market DM deleveraging. So this is the Eurozone crisis. China slowed down and U.S. manufacturing slowed down and so on. And here's the trade related mini cycle, and you can see their forecast is a rebound here. So it's what they call mini cycle recovery. Okay. Capital formation, another indicator. So if you look at kind of the economic strength around the world, you see a little bit of a rebound, and this is a percentage of economies that are growing above trend, and that is suggesting that capital formation, business investment will rebound. And just overall, globally, the percentage of economies in contraction is not scary relative to, say, 2011. So there's nothing here that's telling us that there's a trend to the downside. It just doesn't look that unusual. Even though there's a slowdown, it's not anything scary. This is another interesting chart from Morgan Stanley. It shows the spread between the global economy growth, excluding the U.S. and the U.S. So the rest of the world versus the U.S. The spread. And so you can see the rest of the world is slowing, and the U.S. Maintaining its growth and effectively keeping the rest of the world from going into a recession effect. And then the U.S. is slowed now, and the rest of the world is starting to rebound, which is what Morgan Stanley forecasts, and that's expected to pull the U.S. out of its slowdown, or at least become a tailwind for the U.S. Economic growth. So kind of an interesting trend here. Of course, there's all these lingering questions, about the corporate leverage, the consumer, and so on. So let's take a look at those real quick. Look at the high yield markets. Interesting enough, they don't look as leveraged as some people have been worried about. Investment grade is probably, the leverage trend. Investment grade has been more of a concern. But in a high yield market, which is more vulnerable to a slowdown, things are not bad. And part of the reason is that earnings have been really strong. And with earnings growth, it solved a lot of leverage problems. So these charts show debt to EBITDA, basically debt to earnings, and this is debt to assets. And so leverage has obviously risen since the sort of 2010 level, but it's not crazy. Similarly, if you look at interest coverage ratios improved because these firms have locked some very low interest rates, long-term financing. So on the credit side, the situation isn't dire by any stretch. Companies are leveraged, especially investment grade, and there's some issues in certain sectors, but it's not dire. This is kind of an interesting macro chart. It basically says, look, the GDP um, of the U.S. GDP is growing faster than the 10-year Treasury yield. And if you think of the GDP as a proxy for corporate earnings, and the 10-year Treasury yield is a proxy for financing costs, the spread indicates that we're in a pretty good shape right now. We're growth outpaces interest rates. It's just a sort of an interesting way of looking at it. And by the way, when it comes to the consumer, there are some discrepancies in terms of surveys. We saw the University of Michigan survey pointing to consumer concerns about buying certain goods and things like that. The Bloomberg survey says that the buying climate index is actually in great shape. And in fact, it's at a record level. And again, there are methodologies about how these services were conducted, who they were targeting, and so on. But it basically says that this particular thing is telling us it's not really isn't much of a concern when it comes to the consumer at this point. So yes, there's no question that the economy is slowing. It's potentially could slow dramatically. I mean, we could have this quarter GDP growth could be 1.5% or even lower. And this is a forecast from Oxford Economics, but we're not going down to zero. So that's the kind of the story here. So what are the downside risks to this? Here's a good chart from Moody's Analytics, and it shows on the y-axis the likelihood of a shock, and on this axis it's the how severe the shock will be in terms of the economy. And here we have manufacturing recession. We're effectively already there, so we have manufacturing recession, but its impact on the economy isn't as bad because the U.S. is a service economy. So there's it's definitely a drag, but it's not dramatic. And there are other things like Trump impeachment and so on, which are not really that relevant for the economy. Of course, the big one is trade, and there are other things here. European debt crisis, which is unlikely. Fed chair removed, also unlikely. But these things are possible, and it's something to think about. Trade, of course, is the most important thing. This chart on the left shows the impact of all the tariffs, and how much there will be a drag on economic growth. You can see that escalates. And the chart on the right is the kind of the dollar amount of tariffs over time, and you can see that sort of escalating as well. There are other risks to the economy. One that people keep talking about is a potential oil spike, where you have some sort of a crisis that creates a shock to oil. And the answer here is it's not a big deal for the U.S. because the U.S. is now fairly independent when it comes to energy, number one. Number two, the U.S. economy is far less energy intensive than it used to be. So per dollar of GDP generated, you need a lot less oil. And so oil price spike, could be troublesome. Gasoline prices going to, $5, $6 a gallon. It's definitely going to spook the consumer, but it's not as devastating as it would have been, a decade ago, for example. A bigger concern for me is a further increase in the dollar. We saw that the dollar rising in 2014-15 led to a mini cycle downturn, and there's certainly a concern about that going forward. The dollar is one of the bigger threats. Strong dollar creates a real problem for the U.S. and for the global economy. In conclusion, there are two charts I just want to share. One is, yes, this has been the longest expansion in history, but it also has been one of the slowest, right? It's really slow expansion relative to history. And what is that? That's telling us that because we had the economy got hit multiple times along the way with these three mini cycles, right? And that kept the economy from expanding too quickly. And when you don't expand too quickly, you don't build the frothiness, the financial excess that you tend to build in a fast-growing economy. And so these sort of mini cycles kept growth low and allowed for the expansion to continue without hitting a recession. It's kind of an interesting aspect of this process. As a result, this is the heat map of financial excess monitor, and you can see, if you look at across the different sectors, you can see a lot of red here prior to the financial crisis. So you can see housing, excess, frothiness, commercial real estate, consumer credit, household leverage, and banks. So you see this a lot of red here. Post-recession, particularly now, there's not much going on. I mean, commercial real estate, there's a little bit of a frothiness here and there, but it's okay. And, obviously the federal government has been leveraging up, but that's not an immediate issue. That's a longer-term issue. So this heat map says, well, we don't have the financial excess that we've seen prior to earlier recessions. And part of the reason is the economy has grown slowly, and we've had these mini cycles that kept people nervous. And so people didn't borrow, companies didn't borrow as much as they tend to when they're, economic growth is really fast. So that's, and that in effect is what's going to keep this expansion continuing for some time, because we just don't have this sort of buildup of excess. So that's it. Thank you very much. Just before we go, I just want to say I want to thank all these great organizations that have provided charts for this presentation. And let's see if we can take some questions.
Thanks very much, Lev. The data doesn't lie, right?
Right, exactly.
The charts are so helpful when trying to look at this, very logically. A big focus of the presentation, you mentioned quite a few times, was, the trade war impact. Given that, first of all, what does the data show regarding who's quote unquote winning the trade war? And, given that China is the second largest economy, can the U.S., avoid a recession if China continues to decline?
Yeah, so a couple of things on that. I don't think anybody is winning the trade war.
Right.
It hurts everybody, right? It hurt the U.S., it hurt China, it hurt Europe big time, simply because, Germans can't sell as many cars to China. You can see what it did to their economy. Uh, Simple things like that. So it was the latest downturn was the result of the trade war. Uh, so both the U.S. and China have slowed down. What's interesting is both the U.S. and China are now showing signs of a small rebound. Part of it is China's economy is gradually restructuring in that it's focusing more on domestic consumption, and exporters are finding some other markets. One of the things that happened, for example, is some of the goods that China tends to export to the U.S., they're now funneling through Vietnam and maybe some other countries, basically saying, well, if you don't want to buy directly from us, we'll send it to another country, repackage it there, and re-export it. So this sort of bilateral tariffs are damaging, but there are loopholes around them that people find. But more importantly, I think the Chinese economy has become more resilient and not as export-oriented as it used to be, and so they can weather this. And obviously, the U.S. can weather it as well. If you continue to escalate, right, and tariffs keep going up, it will create further uncertainty, and particularly if you hit consumer products, which is what the Trump administration has been threatening to do in December. And if we get hit with those tariffs, it will spook the consumer, and so you could have an issue there. So that's the concern.
You didn't mention at all. I don't believe you did mention it all in your presentation. Any impact of what's going on in Hong Kong, what's going on in the UK with Brexit? Any risks there?
Yeah, so I actually view Hong Kong as a bigger risk than Brexit. Here's the story with Brexit. Number one, I don't think we're going to get a hard Brexit simply because there is a deal in place now, and I think the Conservatives in the UK will gain majority in Parliament, and I think they'll pass the deal, and you will get Brexit, which will be painful for the UK. But it's not going to be a no deal Brexit, and the impact on the U.S. I think will be minimal. In regard to Hong Kong, that could definitely escalate further. Particularly, we saw yesterday with the Senate, doing what they did in terms of passing this law about supporting the demonstrators, and that could create further tensions with China. You could see a crackdown. All sorts of other things could happen that it could create a problem for the U.S.-China trade deal, and escalation of so it could feed into the trade war, basically, is what I'm saying.
Any other geopolitical risks that should be on our radar?
Yeah. So a good example would be a U.S. military involvement in the Middle East. For example, a shooting war with Iran. Iran is not Iraq, right? Iran is a massive military power, hugely popular. It's got a huge population. It has a lot of control over the movement of oil, and a shooting war out there could become pretty ugly. It could potentially tip global growth into a recession, depending on how bad it gets. So that's an example of something geopolitically. Obviously, North Korea could do the same, but that's much less likely to happen in this environment.
Switching over to locally to the U.S. A lot of talk regarding what ifs based on who gets elected. What are the thoughts there?
So if you look at the spectrum of the Democratic nomination process, it's a pretty broad spectrum of people. And if you get somebody like Elizabeth Warren elected, which is, I think the markets are assigning a good, 30% probability to that. Um, you could have a problem where, have very anti-business government um, and new regulations and a hike in taxes. Again, the probability of that is relatively low because it's unlikely that the Senate will turn Democrat or particularly have a majority, super majority in the Senate to pass some draconian laws. But it's a risk, and so if you get somebody like Elizabeth Warren, um, moving ahead in the polls and so on, you could have some jitters about that.
Mhm.
But it's not an immediate issue. It's more you're talking about 2 years down the road, 3 years down the road when that could become a problem for the markets and the economy.
What about U.S. government debt and the growing deficit?
Yeah, in the intermediate term, that has been fiscal stimulus and government spending has been great for economic growth. All right. Whereas other countries embraced austerity, the U.S. Has been spending and cutting taxes, and so it's been good for growth. Obviously, we're borrowing from the future, but nobody seems to be worried about this. Both parties seem to be okay with rapidly rising deficits and so on, and it ultimately will come back to haunt the U.S. in the years to come. But you're talking about a decade from now, where the government is unable to spend on certain programs, and you basically your required spending starts to dominate. Interest expenses become outrageous. So all of that is going to happen. But for now, we're talking the next couple of years. It's not an issue.
So I have to put you on the spot. At one of our previous webinars, probably about a year or so ago, I think that you said you were um, forecasting a recession, I believe in 2021, and you thought it would be shallow.
Yeah,
Do you still feel the same way?
I don't think so. I think the the kind of the mini cycles of that we've had recently, I think that they kind of replaced this recession. If you look at what the Fed has done, most people thought the Fed is going to continue tightening through next year, and ultimately that's going to result in a recession the following year or late next year. But the Fed stopped. It stopped early this year and then started cutting, and nobody expected that. And once that happened, it changed the game. Basically, given that inflation remains low now, the Fed may be on hold for a while, and so with rates low, even with the trade tensions simmering, I don't think you're gonna hit a recession, next year or the following year. So obviously there are risks to this, but I think the forecasters were not right about a near-term recession. So the situation's changed.
Is it because they based it on on fundamentals that are no longer
They're no
relevant?
longer in place. They were concerned that inflation will keep rising, and the Fed will keep tightening. So rates will rise and push the economy into a recession. This inflation situation has been shocked everybody. Inflation remains subdued. It's there. We still have, we have 1.5 to 2% inflation, um, but it's not rising as fast as people were concerned that it will. Because people said, look, the labor market is really tight, the unemployment rate is really low. So inflation's got to spike. It's the Phillips curve, right? It's just a very simple sort of thing. But that hasn't happened. And so because it hasn't happened, it allowed the Fed to pause and actually reduce rates so it's not pushing the economy into recession.
On the strong job market.
Yeah.
Yeah. All right, Lev, this was great. We had a big crowd here today. Thank you very much for the questions. Thanks for this for the in-depth coverage of this topic. We really appreciate it.
Thanks, John.
So everybody, thanks very much. We will be sending out in the next day or so a follow-up regarding today's webinar, along with the slides and replay. And if anyone has any further questions, please feel free to email them to us at webinars@starmountaincapital.com. And we will be sending out emails within the next few weeks regarding our next our upcoming webinars. Lev, thanks a lot, and everybody have a good rest of the week.